Luskin, what's ahead for this market?
Oh, well, I'll tell you, it's almost like, I don't know, I'm unable to come up with a good metaphor for it, so I'll just...
I mean, is it good or bad?
Well,
let's put it really simple. There's a lot of tough things on the horizon right now. We've got Europe, we've got China, we've got concern about U.S. economy, and yet you're fairly bullish.
Right.
So I want to know why.
Right. I am fairly bullish, and that is because I think it's very straightforward to make a very plain, assumption-free bullish case. The fact is we're only 10% away from all-time high forward earnings on the S&P 500. If we're not there a year from now, I'll eat my hat. So we should have all-time high stock prices a year from now. But it seems like every couple of weeks there's just some asteroid that looks like it's just headed for the Earth, and it's either Ireland blowing up or China blowing itself up or California blowing itself up, and these asteroids always just seem to miss. But, you know,
well, there's another big asteroid up. I mean, so what, first, before I go on to Jeremy, let me ask you, so what is the solution here? I mean, you've got these asteroids. Is this a chance to get in and buy on these dips?
I think it is, and I think one of the things that Dr. Siegel will tell you is that the most fundamental axiom of investing in stocks for the long run is that what you're going to earn is you're going to earn the risk premium on risk that you can't diversify away. And that means that somewhere, somebody's got to bear the risk of holding stocks, which means bearing asteroid risk. And I think at this point, after the terrible recession we've just been through, we can be pretty sure that all the authorities of the world are bending all their powers to avoid those asteroids. Look what they've been doing, scurrying around Europe all week to make that Ireland doesn't blow up. Let me bring Jeremy in here for a moment, because it starts making some out there rather nervous, Jeremy, that you have a Fed that's essentially turned into a printing press via QE2, and that you have the EU and the IMF and the ECB needing to step in to salvage Europe. You know, what's your sort of overall take on this? Is this good or is this bad for U.S. investors?
Well, first of all, I want to tell Don, there's always asteroids out there.
Exactly.
Right.
Good point.
I mean, there's always going to, you know, we all say if you wait till the uncertainty clears up, you'll never buy stocks. I think Don also made a big
asteroids.
Yeah, well, you need a big asteroid. And I think, you know, a good point that was made that I've been stressing so much, next year's earnings estimates on S&P are above the all-time high in 2007. When the S&P was 1575. I mean, you know, there's two ingredients to stock prices. It's the earnings and the interest rate you discount it at. Both those are favorable. It's my feeling if we get some sort of an agreement on extending the tax cuts, even if it's just 2 years for all of them, we're going to have a 500-point increase in the market. I think they're waiting for something on taxes right now.
David, what's your take on this? I know you run a bear fund, so you're paid to be a bear. We should make sure that we qualify all of what you're saying here, but you've got some real concerns.
Yeah, and I am the one guy at the table that called what happened in '08 as well. And if you go back in '07, yes, earnings were strong. And guess what happened in '08? The market fell out of bed and virtually all risk assets fell apart. We are on track for something like that again. Earnings are a lagging indicator. If you look at stock market capitalization as a percentage of U.S. GDP, right now we're at 100%, where the average since 1925 is about 59%. And therefore, we're way above that. Jeremy, don't interrupt me, please.
I will. Go ahead.
So we have massive asteroids out there. China inflation is picking up a lot. It looks like rates of wage growth are above 10%. You have commodities, rubber, silver, and sugar at 30-year highs.
So what are you telling investors to do? David, I mean, you're concerned about inflation in China. I know you're concerned about inflation back here at home. You're concerned about the printing press that the Fed seems to be running. So what are you telling people to do right now? What are sort of the best investment strategies if you're someone that buys into this thinking that there's just too many asteroids out there?
Well, I think people should be less invested in risk assets. They should be less invested in stocks and bonds today. We like being short stocks. We've lost money so far this year. We might lose a little bit more money over the next few months because maybe Bernanke keeps it going for a while longer.
But what about, I mean, commodities?
Gold,
what about,
platinum.
Okay, so that's where you are. Gold, silver.
Precious metals especially, yes.
Okay, Don, what's your take on where an investor should be placing their bets?
Well, I think I think that an investor ought to be getting paid for the risks that are out there. And as Dr. Siegel explained, stocks are cheap relative to earnings, which means you are getting paid a lot to bear the asteroid risk that is always out there. And also, I want to correct the record. Something Mr. Tice said was very deceptive. Yes, it's true that earnings hit their all-time highs before the last downturn, and so if you said, oh my God, earnings are at all-time highs, there'll never be a downturn, you would have been deceived. But nobody was really saying that, because forward earnings started turning down after October 7th, 2007. So you had 6 months warning given by forward earnings that the world was going to come apart in 2008. So it's not that earnings deceived you. Earnings gave you a perfect, distant, early warning signal, which they are not doing now. They are still rising relentlessly every day, not falling like they were then.